All for checking in again here, and want to wish everyone a happy new year, happy 2021, and here's to a much better 2021 because 2020 was something else. I'm going to talk about one of the small handful of price patterns that I would personally consider looking at when I look to short, and that is the bear flag chart pattern. And although I've made a video about the bull flag pattern, and bear flag is pretty much just the opposite of it, I know that a lot of people enjoy a proper explanation of most things that are trading related, so here's the video. All right, so let me be clear that I personally don't get too caught up in the minute details of every single chart pattern. Okay, so I don't need a textbook definition of one, which is why, personally, I look at all of these as just a pause in the current market direction, and I just treat them all as continuation patterns. So in order to spot a bear flag, obviously you have to be in a market that's going down. And as the market heads down, those that are short begin to take profits. And there are times when buyers will start to step in and they're going to help that price rally against the main trend direction. Now, these are really not hard chart patterns to see on the chart. And really, you just have to spot them, have an entry trigger to get into the trade. Okay, so let's break this pattern down. First thing we need to see is an initial thrust down in price. Okay, we want to see some momentum to the downside. And this leg of the price action, they actually call it a flagpole. And you'll understand the relevance of this leg in a minute. Second thing, after the move goes down, we have to see price action against the first move down, right? So price has to find some support. While momentum in the move down, we've preferred, during the formation of the flag, so the pullback, we actually want to see lazy price action, where the bulls don't step up too strongly or too many shorts start to unwind their positions. And third, we just look for price to resolve back in the direction of the previous trend move. And we actually look for that to go to the same extent as that first leg. So from a trader's point of view, what does this mean? So this chart here at number 1, we're getting a steady move down with small ranging green candles, okay, which shows buyers aren't too interested in defending these lower prices. And number 2, price has begun to rally, and the candles that make up that rally, the bearish flag, they don't appear to show much buyer interest, so the shorts are still pretty much in play. Now, price at number 3 has begun to break down with one big move, which shows the seller interest. So we would measure the move into the low before the rally. Okay, at number 4, the move from 3 is projected from the high at 2 to give you your price target. Now, I purposely did not pick a perfect example here with big thrusting momentum candles because rarely do we see perfect patterns. It's more the understanding of what you're seeing that really matters. So when you see price moving down strongly or with very little interest to the upside, we don't see many buyers stepping in. So traders on the sidelines that are looking to enter short, and those that are already in short are going to be looking to take profits. So once price rallies and the traders that are short look to take their gains, sellers on the sidelines then see their opportunity to take a short. And once price starts to break down in the bear flag, sellers look to enter. Right, and this is a lot more interesting, the breakdown, when that first leg down is fairly strong. And you're going to see other articles talking about needing a sharp price action and a whole bunch of other things. The sharp action down would be nice, and it does show strong seller intent, but the sharp price action doesn't always happen in a steady declining market. And actually, sharp price action can also be an exhaustion move. And if that would happen, you're not really looking to take a short on the formation of the flag anyway. But really, once you get the hang of it, the bear flag pattern is pretty simple. So let's kind of put together a strategy that you guys can start to work on. Obviously, you need to determine a down move in price, right? We can use price action for that. And we want to make sure that first move down looks like it deserves another move in the same direction. We want to look for price to begin to rally to the upside. You want to use a sell trigger to enter a trading position short. Make sure you place a protective stop. You can use various techniques with that. And look for a measured move price target or use some other profit taking strategy. And on this one, let's look at this is a Forex chart. And it's a 30-minute chart. And we're going to talk about the first two things here. We're going to talk about the down move and price to rally. So are we moving down? Well, we can see there's an obvious double top, and that support breaks. And when you follow double top pattern rules, that actually confirms the reversal to the downside. Now, price is not really thrusting to the downside, but we do see more interest to the downside instead of price just flying back up. So does price begin to rally? Well, price has found some support, and after a brief range, we see the rally. Now, we're not really seeing some strong momentum to the upside, and we can draw channel lines to contain the price. We want to see slow counter trend moves in the flag, okay? Those upper shadows, I like to see those. So now we need to find a way to get to the trade, a trade trigger, and find a way to set our stop loss. So trade triggers, and I talked about trade entry triggers before, but in short, you could just trail a sell stop order below the lows of each candlestick during that rally. Right? You could wait until a certain number of candlesticks are in the rally before you begin to trail. Perhaps you need to see at least 3 higher lows before you begin to trail. And you can also use any number of trading indicators, such as the MACD, and you can just enter when that fast line hooks in the direction to the downside. Now, lower time frames, they can come in handy. Using a 5-minute chart, you can use trend lines as a way to enter the trade, as you see here in this little box. You need a stop loss, and there are several methods to place your stop, but I always default to the average true range, and I'm going to use a 14-period ATR in this example. I just set the stop 1.5 ATR from the trade entry for the stop. And you can also place your stop just over the high of the candlestick, right? The final candlestick that happened during that rally. So now we're in the trade. Profit targets are going to come next. So how do you exit the bear flag? Well, to find the exit, we're going to do what we call a measured move. And basically, we measure from the peak of the leg down, the flagpole, to where price found support. We're then going to project that same distance from the high of the rally. Now, the reason this is viable is that unless something changes in the market, we can pretty much expect the same type of volatility as we just saw in the immediate past. Now, price is not always going to hit the price exact, but I personally have found this method of taking profits, or at least managing my trade, extremely reliable. And you also have the option of trailing your stop loss, which is not a bad idea if you've actually caught the trade at the reversal from an uptrend to a downtrend. Here's a pretty big trading tip, I think, for this. And I find one way that you can really improve this pattern is to look for the flag to terminate around a previous zone of support, resistance, or previous trading range. Okay, so this is a 30-minute stock chart. And the context is price has broken previous support. So we want to sell this market. So number one, obvious sellers here, right? Price breaking down. We do see a little bit of a push up with momentum. It's immediately wiped out. At number two, price has found support after coming down, starts to rally. And I want you to notice the candlesticks and the lack of strong upside momentum in this bear flag here. And number three, this is a previous range where we have a whole string of inside candles. And price has actually rallied into that zone and stalled. Number four, price has broken down. This line is the length of the flagpole projected from the highest point in the flag. And when you use a price structure such as a trading range, we actually have a zone where price had previous seller and buyer battles. And those are always a pretty good place to look when you're looking for another trading opportunity. So in conclusion, I like trading flags because it takes advantage of the normal ebb and flow of price movements. If you ensure that the flagpole shows strong interest to the downside, it adds to the probability of a continuation after the rally. Using price channels around the flag is going to actually give you a built-in trade trigger when price breaks the bottom trend line. And your stop loss can be an ATR rating like we talked about from the entry, or use the highest high of the bear flag. The target is roughly the same distance as that first push down in price. And you can either exit the trade there or use any number of the trailing stop techniques that are available. Hope you enjoyed this video. If you didn't like it before, feel free to like it now, subscribe, and here's to a much better